Sometimes truth really is stranger than fiction. Just a week ago, if someone had told me that a single tweet from the President of the United States could bring the global silver market, yes, a market worth hundreds of billions of dollars, to its knees, I would have laughed and asked them to check their medicine cabinet. Yet here we are on Sunday, January 18th, 2026, witnessing exactly that. By now, the headlines have likely crossed your feed. The mainstream media is having a field day, laughing, joking, interviewing Danish politicians who are understandably not amused. The circus lights are on full blast, but beneath all the satire, behind the meme-worthy Greenland joke, lies a single sentence that could alter the logistics of the global silver market forever. President Trump has announced a 10% tariff on all imports from 8 European countries, including the United Kingdom, effective February 1st. And if a deal to purchase Greenland falls through, that tariff jumps to 25% on June 1st. To most people, this looks like politics, a trade spat, or another headline-grabbing stunt. But for risk managers at JP Morgan, HSBC, and other bullion giants, this is a nuclear event. Let me break down why. The global silver market runs on a concept called fungibility. The idea that a 1,000-ounce silver bar in London is exactly the same as a 1,000-ounce bar in New York. More importantly, it depends on seamless, low-cost movement between hubs. The banks play a high-stakes game we sometimes call whack-a-ole. When silver spikes in New York due to demand, banks fly bars from London's LBMA vaults to New York to flood the market and push the price down. Conversely, if London runs low, which, thanks to rising demand from India and China, is happening right now, they ship bars from New York to London. This flow is the lifeline of the market. It maintains the illusion that there is always enough metal. But slap a 10% tariff on exports to the UK, and suddenly that flow becomes impossible to navigate profitably. At $90 an ounce, a 10% tax adds $9 per ounce, wiping out the margin on what would otherwise be a straightforward arbitrage. The whack-a-ole game, as bankers know it, is mathematically dead. Essentially, the US just turned its borders into a one-way valve for silver. Metal can come in from non-tariff nations like Mexico, perhaps, but once it leaves the US for London, coming back without a severe financial penalty becomes impossible. This creates a trapped inventory scenario. Risk managers are on Sunday morning lockdown, halting exports because the stakes are too high. Sending silver to London now is like sending it into a black hole. And London? London is in trouble. Vault data shows LBMA holdings at historic lows, drained by flows to India and China. They were counting on relief from New York, but with the tariff in place, the cavalry isn't arriving. Metal that should have flown to London is likely stuck stateside. For the US, this is bullish. The supply stays domestic. But for London, it's potentially catastrophic. Imagine the scenario. London can't source supply from New York, and miners alone can't cover the shortfall. Physical defaults loom. This is why traders are describing the Greenland tariff as a black swan event, an unmodeled, unpredictable disruption that existing algorithms cannot anticipate. Silver trading systems track interest rates, the dollar index, industrial demand. They are not programmed to react to real estate negotiations in the Arctic. Now, the banks are forced into an impossible decision. They can either protect New York or London, but they cannot do both. Because the major banks are US domiciled or heavily reliant on US operations, the logical move is to secure New York. That leaves London exposed to the full force of Asian demand. This could create a bifurcation in pricing, $90 in New York, $110 in London, because the metal simply cannot move between the two hubs. The law of one price, a fundamental market principle, has effectively been repealed by executive order. Next, consider the Roach Motel effect. In normal times, silver moves freely. Banks use a tool called a location swap to balance inventories. Say, JP Morgan has too much silver in New York but needs more in London. Rather than ship bars immediately, they might swap ownership of bars with another bank, knowing physical movement can happen later. The system assumes metal can move back and forth without financial penalty. Enter the 10% tariff. Suddenly, New York becomes a Roach Motel. Silver can check in, but it cannot check out. The arbitrage disappears. Banks are forced to hoard, becoming involuntary preppers. Metal stays domestic, inventories pile up in New York, and London faces shortages it cannot mitigate. This is more than an inconvenience. It's a structural shift in the market. Supply chains that seemed bulletproof now have a choke point. Silver in London can't cover contractual obligations, and risk spreads. Hedging strategies fail. Algorithms, blind to the political origin of the disruption, misprice risk. Traders are scrambling, asking themselves how to navigate a system that no longer operates on familiar rules. For silver stackers and investors, this is a rare moment where policy unintentionally secures domestic supply. The US becomes a vault for critical minerals without even trying. Exporting metal is now financially suicidal. While pundits joke about Greenland, the smart money is realizing that the US silver market just got a wall built around it, a literal prison for metal that wasn't on anyone's roadmap. The timing couldn't be worse for London. Vaults are low, Asian demand is insatiable, and New York's spigot is off. Banks cannot simply send silver to London to stabilize prices because they risk trapping it permanently. What they thought would be a routine Friday night balancing act, a movement of millions of ounces, has now transformed into a high-stakes gamble. The metal stays put, and the imbalance grows. Let's talk logistics, because this is where things get fascinating. Transporting physical silver isn't like moving digital money. Bars weigh hundreds of pounds. Insurance costs, air freight, security, all become exponentially more complicated under a tariff. Once the US imposes even a modest tax on outbound silver, these costs multiply. Banks have to calculate, do I risk sending metal to London knowing it might become unprofitable to return? For most, the answer is a hard no. This feeds into the bifurcation of the market. New York prices may remain orderly, while London faces a vacuum. Traders in Shanghai and India continue to pull metal from London vaults. The more they pull, the higher the London premium. The disconnect could persist until the geopolitical situation resolves, or until banks find creative workarounds, which aren't simple in a market of this size and complexity. And here's where human analysis still matters. Algorithms can't anticipate a tariff triggered by an ice sheet dispute thousands of miles away. Only experienced risk managers can read between the lines and understand the cascading effects. They're already considering hoarding strategies, adjusting hedges, and running stress tests on scenarios that would have been dismissed last week as too unlikely. So, what does this mean for investors and stackers? Keep your eyes on the US market, because that's where the metal is staying. Watch London, because that's where the stress will accumulate. And think of this as a live demonstration of market mechanics, how supply chains, arbitrage, and risk management interact, and how a single policy move can shift the entire equilibrium. At the end of the day, what makes this situation extraordinary is not just the tariffs or the Greenland headline, but the way it exposes the vulnerability of a market we take for granted. Physical silver markets are not abstract numbers on a screen. They are real bars and vaults with physical constraints and political decisions, now have the power to change the math in ways that models and algorithms never anticipated. For bullion banks, this is life and death. For traders, a puzzle. For stackers, an opportunity. And for the rest of the world, a reminder that sometimes reality is far stranger than fiction, and sometimes a single tweet can rewrite the rules of a multi-billion-dollar market. As we continue to watch this unfold, remember that the Greenland headline is only the surface story. The real drama is happening in vaults, spreadsheets, and risk offices as banks try to figure out how to play a game that the US just fundamentally changed. The walls of the silver market prison just got higher, the metal is trapped inside, and every move from here on out is going to count. We'll be taking a deeper dive next, exploring the mechanics of this trap, why hoarding is now inevitable, and what this accidental policy might mean for America's long-term control over critical minerals. For now, keep your attention on the flow of metal, the shifting prices, and the strategic decisions quietly being made behind the scenes. Because while the media laughs at Greenland, the silver market is quietly being rewritten in real time. Picture this. It's Sunday morning, and you're a bullion bank risk manager staring at your COMEX vault in New York. You have 1 million ounces of silver sitting there, and London is on fire. Prices are spiking. Your instinct is to ship the metal across the Atlantic to the LBMA vault in London, flood the market, and calm things down. Easy, right? In a normal world, yes. You load the silver onto a plane, it lands at Heathrow, and London breathes a sigh of relief. Crisis averted. But now imagine next month. COMEX runs dry, and you need that silver back to settle contracts in New York. Here's where the nightmare starts. Because that silver is now coming from the United Kingdom, it hits a 10% US tariff at customs. At $90 an ounce, that's $9 per ounce just to get it home. In the low-margin, high-stakes world of bullion banking, a 10% hit isn't just a setback, it's catastrophic. It wipes out a trade 10 times over. Suddenly, sending that silver to London isn't just risky, it's financially suicidal. The risk managers stare at the spreadsheets and make the hard call, we can't send it. Once it leaves US soil, it effectively costs 110% to get it back. The silver is trapped. The whack-a-hole game, the very system that allowed banks to smooth out price volatility, is broken. London spikes to $120, New York stays at $90, and there's no way to close the gap. The tariff wall becomes an immovable barrier. Prices start to diverge. Market segmentation is no longer a theoretical concept. It's a reality. The same metal, sitting in different cities, starts trading at wildly different prices. And here's the twist. This isn't just a trade war or a political stunt. It's accidental genius. While the media laughs at Greenland, the real impact is the creation of a domestic strategic reserve. Silver that would have flowed to London is now forced to stay in the US. Inside COMEX vaults, available for the US Mint, Tesla, Raytheon, and every domestic player who relies on metal. Ghost supply that might have vanished overseas now remains inside the country. It's America First applied to the periodic table. For London, this is a nightmare. The LBMA is the beating heart of the global physical silver market. For years, we've watched silver drain from LBMA vaults to meet demand in India and China. London has been surviving on a fragile lifeline, the ability to import metal from New York when things got tight. But now, with a 10% tariff, that lifeline is gone. New York isn't shipping because the financial penalty is too high. London is literally and figuratively isolated. This explains why last Friday's withdrawal of 4.2 million ounces from COMEX vaults was so critical. At the time, it looked like metal was leaving the US and heading overseas. But now, with the tariff in place, it's likely stuck stateside. The silver is probably sitting in a warehouse near JFK, wrapped in plastic with nowhere to go. Owners face a stark choice: ship it to London and risk the future tariff, or keep it in the US and sell domestically. Given the uncertainty, the rational decision is to hoard it at home. For the US, this provides a brief physical relief. The domestic market sees a temporary easing of pressure. For London, however, it's about to go nuclear. Silver is global, and if London breaks, the entire system feels it. Prices cannot remain disconnected forever. A $200 London price and $90 New York price isn't just a local anomaly. It's systemic stress waiting to spill over. Panic is contagious. The logistics trap extends further. Many refiners supplying U.S. markets are based in Europe and Canada. If the tariff applies broadly, imported silver bars from those regions become 10% more expensive overnight. This raises replacement costs for U.S. dealers. Private mints that buy grain from European refiners suddenly face higher input costs. Retail buyers, APMEX, JM Bullion, or anyone sourcing physical rounds, see the increase reflected in premiums. Even if the spot price remains $90, the cost to actually buy and take delivery climbs. This creates a natural floor under premiums. What we're seeing is the financial equivalent of vulcanization. The smooth, frictionless trade of the past 3 decades has been baked into something rigid. Walls, tariffs, and trapped assets are now the rule, not the exception. In this environment, holding physical metal is no longer optional. It's essential. You don't want exposure to contracts that may never deliver. You don't want ETFs that store metal in a jurisdiction now blocked by tariffs. You want the metal in your hands. The Roach Motel effect is in full force. Silver enters the U.S. financial system, but it doesn't leave. It's being hoarded by the state, by banks, by industry. The shell game is frozen. Everyone's cards are on the table. When the world finally sees the holdings, the illusion of abundance may crumble. Meanwhile, the London crisis is looming. The LBMA, unlike COMEX, deals in real physical metal. It's the settlement hub for global trade, where metal actually changes hands. Over the past 3 years, London has been bleeding. Vaults have emptied. Free, unencumbered silver, metal not already tied up in ETFs or contracts, is critically low. They've survived only by leaning on imports from the Americas when shortages hit. But that lifeline is now severed. Banks in New York won't ship to London at the risk of paying the 10% tariff. London is cut off from COMEX, from Mexico, from any reliable foreign supply chain. Demand from India and China remains insatiable. The city is entering a siege mentality. When Monday opens, traders will realize they are physically insolvent. They've sold more silver than they can deliver, and the backup supply isn't coming. The result? A local default in London becomes not a question of if, but when. Physical dislocation will have immediate effects. Prices in London could diverge sharply from New York. Contracts may fail to settle. Panic could ripple through ETFs and derivatives that rely on LBMA settlement. The disconnect may persist until the geopolitical and trade situation clarifies, or until some emergency physical shipment is arranged, which is far from guaranteed in the current environment. Add to this the network of refiners. European and Canadian refiners now face a 10% tariff to sell into the US. The ripple effect touches every stage of the supply chain. Dealers, mints, and consumers all feel it. Premiums on physical silver in the US rise, even if spot prices remain flat. The market becomes segmented, not only geographically, but operationally. From a strategic perspective, this scenario demonstrates why human analysis still matters. Algorithms can track interest rates, dollar indices, and industrial demand, but they cannot anticipate a tariff triggered by a dispute over an Arctic ice sheet. Only seasoned risk managers can project the cascading consequences across vaults, refiners, and global supply chains. For investors, the lesson is clear. Physical possession matters more than ever. Contracts and ETFs tied to London or other vulnerable jurisdictions carry hidden execution risk. Holding metal in a U.S. vault or secure domestic facility provides a level of security that trading screens can't replicate. The Roach Motel effect guarantees that once silver enters the U.S. financial system, it's effectively immobilized. Hoarding isn't optional. It's built into the mechanics of the market now. The global picture is stark. New York is trapped, London is starving, and Shanghai continues to draw metal from the remaining global supply. The disconnect between hubs may widen before any resolution. Market participants will have to navigate a world where arbitrage opportunities are no longer simple, and historical pricing relationships may fail entirely. The operational implications for banks are equally dramatic. A simple shipment of metal now carries strategic consequences. Any decision to move silver must consider tariffs, potential defaults, and the physical availability of supply downstream. The game of balancing supply between hubs is frozen. Banks must hoard, not trade. Location swaps are meaningless if the metal can't return without financial ruin. In short, what the media frames as a quirky headline about Greenland masks a systemic shock to the silver market. Physical scarcity, geopolitical friction, and operational risk converge. The system that has functioned for decades, built on free-flowing metal, seamless arbitrage, and fungibility, has been fractured in a single policy stroke. For bullion banks, it's a wake-up call. For traders, it's a puzzle with real-world stakes. For stackers, it's a moment to watch closely. Every ounce in the US now represents both a hedge and a strategic reserve. The metaphorical walls of the silver market are higher than ever, and metal is trapped inside, whether in vaults, warehouses, or industry stockpiles. Monday morning in London may mark the start of a historic default. New York is a fortress, London is under siege, and Shanghai is the predator waiting at the gates. The logistics are broken, prices are next. When the market reacts, it won't just be a price move, it will be the crystallization of systemic risk that has been building for years. Imagine waking up on a Sunday morning and checking silver prices only to see a yawning gap between New York and London. In New York, silver is trading at $90, while across the Atlantic, it's $110. Why? Because London is physically short, and the metal can't flow back to the US due to the 10% tariff. Arbitrage, the very mechanism that keeps global markets in sync, is dead. The old concept of a unified global spot price is gone. Today, the real price is wherever the metal actually sits, because ownership without delivery is nothing more than a promise. Before we dive deeper into London's looming crisis, there's something I need to address. We are boring currency. We are the source of this analysis. Hours are spent combing through vault reports, trade flows, and geopolitical developments to connect dots that most overlook. Lately, a wave of copycat channels has appeared online, all using the same AI Asian avatar, parroting our scripts word for word. For clarity, we have only one channel. This one. We are only on YouTube. We do not have a Twitter, a Telegram, or a crypto channel. Anything else claiming our research is not affiliated with us. If you appreciate the work we do, the deep dives, the forensic analysis, please help protect the community. Head down to the comments section and type, "Staying with the original." Let the algorithm know you value real research, not recycled scripts. Now, back to London. The bifurcation of prices is a nightmare for banks. Most of them operate global books, hedging positions across hubs, long in London, short in New York. Normally, these positions offset each other, keeping exposure manageable. But when London skyrockets while New York lags, their hedge collapses. They are forced to rebalance, buy back shorts in New York, sell longs in London, which creates buying pressure stateside. Paradoxically, the tariff that traps silver in the US is also pushing the US price up, as banks scramble to protect themselves from London's implosion. The unallocated silver accounts in London are another ticking time bomb. Millions of investors hold unallocated silver with LBMA member banks, essentially a fractional reserve system for metal. These accounts are a promise, not physical metal. If London's supply lines are cut, the risk of default on these unallocated accounts skyrockets. When investors realize the situation, expect a rush to convert unallocated credits into allocated bars. But here's the problem. There aren't enough bars. The banks will have to compete in the open market for any physical metal they can find. A liquidity crunch morphs into a solvency crisis almost instantly. The Greenland tariff has exposed a hard truth. The global silver market is not a single unified ocean. It's a series of pools, each with its own supply constraints. London is draining fast. New York is swelling with trapped capital, and the US market is now arguably the most secure in the world. If you hold physical silver in the United States, you are holding a strategic asset. If you hold paper in London, you are holding a liability on the verge of stress testing. Monday morning could be chaotic. Arbitrage bots will likely fail to manage wider spreads. The 4.2 million ounces withdrawn on Friday are now effectively stuck. Owners of that metal are weighing two options: ship it to London and absorb a 10% tariff, or sell domestically. The obvious choice is to keep it stateside. This will stabilize US supply, but at a higher price point. The tariff trap is a textbook example of unintended consequences. A dispute over an Arctic island has triggered a financial meltdown in one of the world's most important commodity hubs. In a market running on minimal physical slack, a 10% tariff is the spark in a powder keg. London is burning, and the bridge to New York is gone. Consider the long-term implications. Silver trading is entering a new era of regional pricing. The days of a global frictionless market are over. Prices will now reflect geography. Silver in the United States will trade at a premium because it is trapped, strategic, and available for domestic industrial needs. Silver in London is stranded, isolated from American production, and vulnerable to Eastern demand. Banks can no longer rely on smooth flows to suppress prices. Suppression depends on certainty and liquidity. Introduce a tariff wall and hedge models collapse. Basis risk, the difference between cash and futures positions, becomes unpredictable. Commercial banks reduce leverage, short positions unwind, and paper shorts exit the market. Artificial suppression is gone. Silver finally begins to find its natural equilibrium. From a structural perspective, this has profound implications for the investor. Geographic diversification as a hedge is effectively dead. Moving metal across borders is no longer reliable. The safest silver is the silver you physically control. Spot prices, as reported by exchanges, are now mathematical averages of two broken systems. The real value of your stack comes down to replacement cost, what it would cost to actually buy physical metal and take delivery. Ignore the illusions of the ticker. The tariff also foreshadows a shift toward resource nationalism. Countries are increasingly likely to hoard strategic commodities, knowing that global supply chains are fragile. Hard assets, physical silver, gold, critical minerals, are returning as the most reliable collateral. The Greenland tariff has locked the door. Metal that enters the U.S. is staying here, whether held by industry, banks, or the government. For holders of physical silver, this is a unique moment in history. The London crisis is still unfolding. The LBMA handles the bulk of physical trade, including flows to India and China. Over the past 3 years, their vaults have been steadily drained. Unencumbered supply, the kind that can be freely delivered, is critically low. The system survived because New York could ship metal when needed. With a 10% tariff, that lifeline is severed. London is effectively an island, isolated from COMEX and other sources of supply. This is a recipe for default. When Monday opens, London traders will realize they cannot meet obligations in physical metal. The result is a local default risk that could ripple globally. Meanwhile, New York becomes a fortress of trapped capital. The metal here cannot leave, which creates strategic security, but also pressures the banks. They must manage inventory carefully, rebalance hedges, and navigate a market where prices are increasingly disconnected. Supply and demand are now dictated by geography, not markets. Premiums for U.S. physical silver will rise, reflecting replacement costs, not spot quotes. Refiners in Europe and Canada face higher costs to supply the U.S., which trickles down to private mints and retail buyers. Even if COMEX prices hold steady, premiums on actual silver will adjust upward. The old assumption of frictionless trade is gone. Metal in your hand is no longer optional, it's essential. This bifurcation of prices, coupled with trapped supply, changes the mechanics of the market entirely. Arbitrage is broken, hedges fail, and unallocated silver counts are under threat. Paper claims in London are becoming liabilities. Physical silver in the US is now the ultimate insurance policy. Investors need to think strategically, not speculatively. The lesson for individual investors is clear. First, geographic diversification doesn't protect you anymore. Your safest metal is in your possession. Second, ignore the quoted spot price. It is increasingly irrelevant. Value your stack based on replacement cost and availability. Third, think long-term. Resource nationalism is here, and physical assets are the only guaranteed collateral. As the week unfolds, expect volatility, unusual spreads, and confusing messaging from banks. But behind the noise, the truth is simple. The logistics of the market have snapped. Trapped silver in New York, a starving London, and an unbroken flow of demand from Shanghai create a perfect storm. The trajectory is up, and the floor has been reset by policy, not markets. The U.S. government has inadvertently created favorable conditions for physical holders. Hold your position. Don't get shaken out by short-term volatility. Eventually, prices will settle higher than $90. Silver is no longer just a traded commodity. It is a strategic asset anchored in the U.S., a firewall against global scarcity, and a hedge against fragmented markets. Finally, to our loyal viewers, the copycats are out there, but you are here because you value real analysis. Leave a comment saying, "I'm staying with the original," to show you are part of the community committed to understanding the system, not parroting it. The week ahead promises historical volatility. Stay grounded in the physical reality, not the paper illusion, and watch how silver's new regional equilibrium unfolds. We'll see you on the other side of the open.